Hey everybody, Aaron Dillon here, Managing Director of AG Dillon & Co. We're a venture capital firm focused on pre-IPO companies with investment funds for individual investors, family offices, financial advisors, and institutional investors. All right, so I got a pre-IPO company update for you here for the week ending 03 March 2023. Today we'll hit on big company news for last week, large capital raises, individual pre-IPO company stock performance update. All right, so I wanted to take a look at what is happening across valuations for the largest VC-backed tech companies. I like to look at the primary financing round's last valuation and adjust that for the stock's secondary market performance. I also consider 409A announcements in there too. That's an internal valuation that's set by the company each year. Sometimes those are publicly announced. If it is, I'll include it. Also important, I'm showing companies that here that are active in the secondary market. So great businesses like Canva, Miro, and Plaid aren't included. They don't have big secondary markets. All right, so here are a few highlights. SpaceX and N26 are the only two companies that post positive gains for their last primary financing round. SpaceX just raised in January 2023 and was up. And I'm showing from the last round in June of 2022 to the end of February of 2023 numbers here that it was up 9%. N26 is like a steady Eddie. These guys have basically zero volatility in the stock, which is wild since their last primary round, showing up 1% as of the end of February. Big losers are Instacart down 77% since the last primary round. Kraken is down 68%. Chime's down 67%. Those are big, big downturns. Every stock outside of SpaceX and N26 is down double digits, with most of them down, actually, a majority of them down 40% or more. It's just brutal. From a ranking perspective, SpaceX and Stripe are still up top. Databricks jumped up 2 spots ahead of Instacart and Checkout.com. Big movers were N26 moving from number 16 to number 9. That's a 7 spot move. And Rippling from number 14 to number 8. That's a 6 spot move. That said, my good buddy Don Needy at Social Leverage constantly reminds me that liquidation preferences, for preferreds come into play in situations like this where the valuation is a dramatic drop. When venture capital firms invest into a company, they typically get preferred shares. Preferred shares have a liquidation preference, or the venture capital firm is guaranteed to get a specific return on their investment before other shareholders. So there are times where the VCs can command up to a 2x plus return on their investment through this liquidation preference. So it's a big deal. You got to pay attention to this, especially when valuations come down. So it's not as simple as just buying the stock. It's important to understand if the stock that you're buying is preferred or common shares. And if it is preferred, where exactly in the cap table you are in that stack, because there's even different levels of preferreds. So you got to keep an eye on that. And naturally, debt comes first, preferreds come next, and then commons after that. So naturally, when a pre-IPO stock prices are going up, none of this is really a problem. But if it's going down, then like they currently are today, you need to be smart about how you're transacting. All right, so on to another kind of unflattering topic, Silicon Valley Bank. Silicon Valley Bank, or SVB as it's affectionately called with venture firms, serves private fund managers like PE or venture capital firms and their portfolio companies. The bank is the 16th largest in the U.S. with 209 billion in consolidated assets per the Federal Reserve. That's their December 31st, 2022 numbers. SVB announced a balance sheet restructuring that included an equity capital raise. So you see SVP took in substantial deposits in 2021 with the VC boom and subsequently bought long-dated mortgage-backed securities and other allowable securities, right? So as you know, banks need to balance their balance sheet. So they got to take in a lot of deposits. You got to issue loans, or you got to buy qualified marketable securities to offset those incremental deposits. With the rapid Fed funds rate increases and the bond prices drop dramatically, right? So rates go up, bond prices go down when rates go up, right? And pair this with customer withdrawals as venture capital firms were not funding businesses, and SVB VC-backed companies needed cash to run their businesses, so they're withdrawing money, deposits from the bank, and 9% of SVB's debt portfolio is in loans to early and mid-stage VC-backed companies who will most likely default on their loans. It made it a very challenging situation for the bank, and these circumstances required a balance sheet reset and a capital infusion. SVP's management team made the announcement on Wednesday, the 8th of March, and customers started to pull deposits. And there was currently a run on the bank. So SVB stock price plummeted by more than 60% on Thursday, 9 March, and was down another 60% in pre-market trading on Friday the 10th. I'm recording this on Friday morning. SVB announced pre-market that they are looking to sell the business. So something's going to happen here or over the weekend. It kind of smells of the great financial crisis, to be honest with you, and what was going on with some of the banks during that period. It's just an incredible turn of events. The downstream impact of what this could mean for venture capital backed companies is really interesting. A lot of late stage VC backed companies were using debt from the likes of Silicon Valley Bank to fund growth in their businesses. And this was better than versus tapping the equity markets with very depressed valuation. We just went through those earlier, as we previously discussed. So who wants to raise capital and lock in a primary financing round valuation that's 40% plus off your last round? Venture debt is a way to kick the can down the road and still deliver an incredible round and increase market share. But wait until the broader market comes back to do the equity markets, right? So you can drive growth, right? You can pick up market share by using the venture debt, and then come back when the markets come back and do the equity round, and hopefully you just keep going with the primary equity round. You get a nice, kind of consistent trend on primary financing round valuation. But with this event, I believe that all lenders to venture-backed companies with this SVB kind of debt restructuring and potential sale here, I believe that all the lenders to VC-backed companies are going to get more conservative. Lenders will be active, but there's going to be less capital out there, and there's going to be a higher risk premium associated. Also, some companies, if they're not profitable and they're not growing well, I think they're just going to be out of luck. They're not going to be able to find vendors, and it's going to force them to make some dramatic expense cuts to get profitable. So they don't need debt or capital anymore. So we're talking layoffs, etc. Or they may just be forced to go to the equity markets if they can't cut deep enough at these depressed valuations. Just not a great situation. As an investor, it's a very interesting time for us, right? So there's an old Baron Rothschild quote that says, buy where there's blood in the streets, right? Buy when there's blood in the streets. And that's literally what's happening right now. So I got a CIO buddy of mine that tells me he thinks that this could be one of the greatest investment opportunities of our lifetimes. You have to have a strong constitution to step into markets when these kind of events are occurring. But those that have the guts to do it stand to make outsized returns. So, in my opinion, just be smart and pick your spots. You got to diversify. You got to look for quality. You got to find great management teams. Ensure that the cap table isn't against you with all this, preferreds with these crazy liquidation preferences. If you're able to pull this off, I believe you stand to make a great return. All right, now let's look at some big capital raises for the week. We got one new decacorn and two new unicorns this week. So it's a big week, right, for capital raises. So Wiz is a cloud security platform. It raised a $300 million Series D at a $10.3 billion valuation. That's a 72% increase from its last round in October of 2021. That's a new decacorn, folks, right? So Insight, Salesforce, Sequoia Index Ventures, Bernard Arnault, and Howard Schultz, that's Starbucks CEO, all invested. Kindbody, a women's healthcare services biz, and Headway, an online therapist solution, both reached unicorn status this week. Kindbody put up a $1.8 billion valuation. It's 194% up from its last round in August of 22. That's awesome valuation growth there. And Headway was put up a $1 billion valuation. It's up 30% from its last round in May of 2021. Headway had some big hitters in the round two with Thrive, Andreessen Horowitz, and Excel all investing. So keep your eye out for that company. Okay, so now let's take a look at secondary market stock performance for the last week. Pre-IPO stocks were down for the week, a negative 42 basis points. S&P 500 was up 2%. S&P 500 growth was up 2.01% for the week. Pre-IPO stocks were trailing public stocks year to date by approximately 7.5%. OpenSea and Kraken incredibly still lead the individual stock performance year to date. You would think with all the issues surrounding crypto and NFTs that these companies that would not be the case, but perhaps it's like last man standing trade. Like these two companies are still out there cranking in the crypto space, in the pre-IPO space. A lot of the other ones have kind of fallen away, so they're probably getting a lot of attention there. Brex and Databricks are also hanging in there, up 12% and 9% respectively. Chime and Airtable are down big. Chime's down 32%. Airtable's down 22% for the week. Stripe, Discord, Flexport, and Epic Games are all down around 15% year to date. Kraken was the big winner for the week, up 13%. Revolut was down 7%. Rippling was down 6%. And okay, let's end it there. If you have any pre-IPO stock research needs, please reach out. Love to dive in with you. Also, we have 2 funds available for investment right now. For SpaceX only exposure, visit agdillon.com/SpaceX. The big rocket Starship is launching soon, and their internet satellite business, Starlink, is scaling fast. So it's a great entry point to get into SpaceX, in my opinion. We got about $3.4 million raised to date, and we aim to close the fund in mid-March, or excuse me, beginning of April. And for diversified pre-IPO exposure, check out agdillon.com/top15. That's SpaceX, Stripe, Canva, Instacart, Epic Games, Discord, Plaid, etc. Diversified exposure to pre-IPO stocks. Thanks, and we'll see you guys all next week.